welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been delivering investment research, ideas, stock picks since 1970. I'm Chris Preston. I'm editor-in-chief and chief analyst of Cabot Stock of the Week.
And I'm Brad Simmerman, the web editor and the chief analyst of Cabot Wealth Daily. Big three this week: Fed, interest rates, jobs numbers, same as it's always been. So we're going to skip it and we're going to go straight
You just did it. That was the big three.
That was the big three. We're going to go straight to a conversation with Andy Crowder, chief analyst of Cabot Options Institute, to talk all things market, volatility, etc. Chris, I believe you have maybe more of a structured intro than that.
Well, no, that seems plenty structured. Well, so Andy is, as Brad mentioned, runs our Cabot Options Institute newsletters. There are 4 of them. And here are his returns since inception, which you launched, beginning of June 2022? Is that right, Andy?
Yep.
Yeah. So there are 4 of them. One, quantitative trader is up 165% with 35 out of 40 winning trades since launch. Earnings trader up 78%, 26 out of 34 winning trades since launch. Income trader up 97%, 50 out of 62 winning trades. And then pulling up the rear merely with a 14% gain is the fundamentals trader, which has several portfolio's, but the average gain has been 14%. This is against the backdrop of a market that is basically flat since June 2022, since launch. Andy, how, at a time when no one is really making any money, the last year and a half, essentially, how have you made this much money? Explain to people.
That's a good question. So it's not that everyone's been losing money. In fact, a lot of people that sell options, they've been making money, and a lot of that has to do with the volatility, as seen through the VIX. And during that period, especially early on when the market was declining, we were in the middle of a bear market. Volatility was really high, which means that as an option seller, I can sell premium for much higher prices, and that certainly helped with the returns. And being able to do that on a regular basis, and again, my world is every 30 to 60 days, as opposed to longer term views. So being able to sell that over and over every 30 to 60 days, again, particularly when premiums at heightened levels, allows me to lower my cost basis. So that's really the majority of it. And I've been somewhat directional early on. So we were a little bit bearish. That certainly helped, particularly with quantitative trader. Over the last few months, basically the summer months, as most of us know, volatility has been flat. So some of those services have been flat over the last few months, but we're starting to see them pick up. But it's the way that I run my services. Again, we have 4 different services, but they all balance each other out. So they all work off of one another. And I created them for that reason. So there's a bit of diversity. While one might be, challenged, there's going to be others that are going to be performing well. So being able to have that diversification and take advantage of those different market environments has certainly been advantageous.
I just did the math just to correct myself a bit. I said market's been flat since June 2022, start of June 2022. S&P's up 4.4%. So still, you're beating that handily, which is why we wanted to have you. One big reason we wanted to have you on today, at a time when stocks are backtracking, although this morning has been encouraging, which we can get to that. And it's been especially difficult time for growth investors. It's been a difficult time for value investors too, if you're growth or value, and even dividends, with the way that yields are, thanks to the Fed in things like CDs and treasuries. So yours with double-digit returns in all your services really speaks to. I think you've talked about you wanting to be sort of the house. If you look at it from like a gambling Vegas type style, you want to be the house, or you are the one who makes money sort of no matter what people are gambling on. Is that kind of the way you approach it?
Yeah, I mean, it's more of a quantitative approach, a statistical approach. I base a lot of my decisions on probabilities, high probabilities. So that certainly helps for sure.
Now, one thing that I've been curious about with because volatility's been tamped down since June, right? It's been got down to 1390, 1365 on June 8, and it hasn't gone above. It had not gone above 18 until Tuesday, the 3rd of October. No, looks like the last week of September. So how did you adjust your strategies? Did you adjust your strategies when you were dealing with that sort of persistently low VIX? Or was your 30-day, 60-day cycle enough to sort of time that out?
Yeah, really quickly before I get to that, Brad, going back to your question, Chris, a lot of it has to do with just consistency. And you were talking about growth stocks, value stocks. They're going to have their day. And in my opinion, that's going to be fairly soon because I'm a strong proponent of mean reversion. But what I'm doing, it's just, I'm not seeing huge gains or huge losses. I'm ultimately trying to be very consistent with my returns. So they're a little more reliable in that regard. But that's kind of how we handle things, and regardless of the market environment or even volatility. Going back to your question, Brad, with volatility. So if you remember a year ago, pretty much on the day, that's when inflation was skyrocketing. People were very fearful. We had the VIX at what, 35-ish? And that was new to everyone. We're coming out of a bull cycle that had lasted for a decade or more. And so people were kind of new to, oh, these are some serious losses that we're seeing in our portfolios. And then you started to see people buying protection through, various measures, mostly buying puts, et cetera. So that's going to increase volatility. So we were selling a lot of options. We were making very good money at that time because premiums were so high. And then what is it, towards this past February, when we had the so-called bank crisis with a lot
March.
Yeah, so February into March, and the VIX didn't pop up to 35. It popped up to what, 25-ish. So again, there was a little bit of fear in there. And now we're seeing the VIX at, struggling to kick above 20. It's been kind of hovering around 17, 18. As you said, during the summer months, it was around 13-ish. But it's, again, struggling to kind of push past that 20. And what that tells me is that, this is kind of a normal correction that we're seeing. And we're not seeing that much fear in the market. If we remember, we were seeing record gains in the NASDAQ for the first 6 months of the year. I mean, the NASDAQ 100 was up 40 some odd percent. We were seeing unbelievable gains in a lot of these, underlying indexes. So kind of going back to your question, during the summer months, again, a lot of it has to do with just diversifying our approach. So during those low volatility environments, that's when my fundamental service was taking off, because we're using we're buying leaps and we're selling calls against those, essentially using a poor man's cover call strategy. But going back to that, going back to the other strategies like quantitative trader, where I'm selling spreads, bear call spreads, bull put spreads, iron condors, etc., I was just paring back my positions. That's kind of how I handle those really low volatility environments when it comes to selling a premium using spreads. I would still have positions on and I would increase my probabilities a bit. But for the most part, I would just pare back the amount of trades that I'm making on a month-to-month basis. But it certainly didn't impact our returns in that, we were seeing losses or gains. We kind of stayed somewhat even over those, that 2 to 3 month period.
Well, I think there's something to there always being volatility somewhere. Right. Like, I mean, just when we're quoting the VIX, we're looking at the S&P 500 volatility measure, but each individual issue is going to have its own implied volatility. So I guess selectivity is also something that probably came into play for you more.
Always look for other underlying issues. And again, I'm looking for implied volatility regardless of what it is. That's kind of ranging between 25 and 35. That's kind of my safe zone where I like to sell premium. And like you said, there's always going to be something that's volatile or something that has implied volatility in that range. whether it's an underlying stock or an index or just simply a sector ETF. So we're constantly scouring, our screens for those types of opportunities.
And Andy, you and I often think a lot alike, hence we're wearing the exact same shirt on today's podcast for viewers. Actually, we both live in Vermont. They just hand you a closet full of those when you move here, full of these when you move here. But my point, I think you are a bit aligned with me in that I think you mentioned mean reversion. You're expecting a reversion to the mean with all the selling that's been happening. I think you're somewhat bullish for over the next few months. I think we talked offline. You're looking at S&P 4,200 as potentially being a bottom or potential support level, which we're sort of seeing a little bit just in today's market. Brad has been. We've made some fearless and probably wrong predictions about the market for the fourth quarter on here last week. Brad thinks we're headed to 3,900 range, but that's potentially. He thinks that the S&P will be down from here the next few months. Andy, where do you stand on that?
So I'm not really the greatest of market forecasters because, as we always say here at Cabot, the crystal ball effect.
Yeah.
So that
I was just trying to get you to say crystal ball.
No. That being said, what I'm seeing, from what I look at on a daily basis is we have a short-term oversold market. And we have, seasonally, and so you couple that with seasonally speaking, September is always very weak historically.
Yeah.
So, and we were coming into September with some really nice gains on the year. So to see that pullback, and what are we seeing? 5% losses in September, pretty much across the board, maybe 6% in the Russell and the NASDAQ. But for the third quarter, I think we were down 7% or something like that. And we've seen since 2022 these drops of 7%, 3 different times, 7 to 8%. Well, now we're coming into the fourth quarter. We're getting through that seasonally weak period. We're coming into the fourth quarter where we're seeing, oversolds across the board for the most part in all indexes. To me, that means that, and oftentimes the fourth quarter is particularly after a weak third quarter. I think since 1990, we've seen 11 times that the third quarter has been down. 9 of those times in the fourth quarter, we've seen the market up. So I'm kind of like following that track. I do not think that we're going to see a collapse unless something unforeseen happens. I think a lot of this Fed stuff that's been going on, we're seeing tops kind of come into place, at least on a temporary basis. And again, a lot of those declines that we saw since early 2022 came with those rising interest rates, where we saw the 10-year going up 1.8%, 1.7%, 1.5%. And we saw those declines as a result. But I think we're kind of through that, at least for the moment, which means that I do think that we're going to see a fairly strong fourth quarter.
Yeah, to piggyback on the stat that you just gave, since 1990, I think Ryan Dietrich of Carson Research Group, who's really good follow on Twitter, really good market historian, said there've been 9 times since 1981 the S&P has been up double digits through August, through the first half of the year, and then followed by both July and August being down. Both August and September being down months, and all 9 times that's resulted in the fourth quarter being up by an average of 9%.
Right.
Doesn't mean we're definitely going to be 10 for 10, but it's pretty good historical number.
Right, and a lot of market participants were waiting for quite some time for those job numbers to pull back. Well, they did so in earnest in June, and people thought, oh, well, we're going to see, negative numbers come into play, in July and August to September, and that wasn't the case, right? But we're still seeing a steady downtrend. And then PCEs below 4% now, which is the first time that we've seen in a couple of years. And I know I'm getting more towards the macro stuff, which I don't, I tend to like to stay away from.
Here's our weekly Fed discussion.
Yeah. But I think you look at all of these things in combination, and to me that, it spells that we could see a nice return going forward, particularly over this last fourth quarter. I do think in the near term that we're going to see a little bit of a bounce given what we saw in September. And oftentimes, like I said before, when we see that weakness, particularly in historically weak months like September, those gains going forward are typically fairly strong.
Well, Ed Yardini, who runs Yardini Research, who I think, other than Ryan Dietrich, is probably the most cited outside analyst name that we reference. Yeah. He's bullish for the fourth quarter as well. I did not expect to be like the solo bear on this podcast. I thought I'd have Andy in my bear cave with me. So I'm going to lay out a little bit of my sort of base case, my bearish base case right now. Fed. Yeah. Most notably, it's going back to that 10-year. So something that Tyler London, Cabot Small Cap and Early Opportunities chief analyst, had written to his subscribers a couple of months ago was waiting for the de-inversion of the 10-year and 2-year Treasury yield curve. And the sort of picture that he painted was, if de-inversion is short-term rates falling below longer-term rates, it's a bullish scenario. It means that the market's not really pricing in higher long-term rates. If we get de-inversion via the 10-year rising up over the 2 years, that's a bear case, because what that means is that the market is beginning to price in not necessarily perpetually higher rates, although that's certainly possible. I mean, you can't have zero interest rates forever, but that's sort of what we've seen since April of 2023. The 10-year has gone from roughly 3.25 yield to 4.78 right now. If you look at a chart of it, I wish stock charts looked like that right now. But the de-inversion that's pricing in higher long-term rates that one is a big risk factor for me, because it sort of devalues every other asset class. If you can get 5.5 or 6% in bonds, you mostly aren't buying stocks. And then the valuations are pretty sky high. I think the arrival of earnings season will maybe crystallize it a little bit for me. If we start seeing some of these companies come out and miss even lower earnings, even after lowering earnings expectations in the summer months, if we start seeing them miss that, I think that tells me that some of these interest rate changes, some of these macro elements, and some of the valuation metrics are probably pointing to lower prices. And then one last item, just because I know Mike's been writing it constantly for the last week or two, oversold conditions can remain oversold if we enter a trend. So oversold is great if it shows a reversal, but until it shows that reversal, I would just say, take it with a grain of salt.
And so I would combat that with, and again, my world is different than Mike's and Tyler's. Again,
of course,
I'm looking at 30 to 60 days out. And so I use several different mean reversion tools, various RSI tools, and a couple other mean reversion tools. And over different time frames, 2, 5, 7, 14 days, and several others. When those all line up and we see oversold conditions, more often than not, we see a bit of a bounce. And so I agree with you when it's on the other side and we're seeing overbought conditions, because I've experienced this many, many times when we have incredibly overbought states and I try to fade the market, which means I'm going to go in the opposite direction, and it just keeps going higher. That has rarely been the case. And again, I'm looking out 30 to 60 days. That has been, it is very rare to see that when we have oversold conditions. Because it's just, people are starting to see. And again, I find that I go back to the VIX and I find that there's not a lot of panic going on. And I do feel as though a lot of the selling that's been going on, I mean, again, we've lost 7%. I mean, it's not 25%. We've seen these types of declines 2 other times over the past year and a half or so.
Yeah.
So, and if you look at the VIX, again, with it sitting right around 17, 18 versus where it was last year at 35, I think the market's kind of telling us something, at least at the moment. I mean, obviously, all those things can change at the drop of a hat. We all know this. But as it stands, I don't think that we're seeing near the panic that we were seeing earlier on. I think a lot of things are starting to normalize. I do agree with you, though, Brad. I think the valuations are very high. I think they've been that way for a long time, though. So, this is not near term, and this wasn't even after we saw that last decline, I still thought that valuations were fairly high, even at that point.
Yeah.
As we know, the market doesn't always work on a fundamental basis, oftentimes, particularly over the short term. And again, that's kind of the where I play, the sandbox that I play in, things can go very differently over a 30 to 60 day time period, or even shorter. So
yeah, I certainly hope you're right. I mean,
Brad, you mentioned earnings, and the earnings season starts next week with the banks. So Andy, I mentioned you have an earnings trader newsletter as part of your Cabot Options Institute group of advisories, and that, as I mentioned, up 78% since launch. Tell me about how you approach earnings season and how you approach a trade. Like what prompts you to make an earnings season related trade in that service?
So with earnings season, I'm not going out and just, playing a bunch of earnings trades. I typically make 6 to 8 earnings trades per earnings season.
Yeah, 34 total trades since, in 16 months. So that tells you right there. Yeah.
So what I'm really looking at is there's something called the expected move. So we go in to an earnings event, and volatility always, this is one of the few guarantees in the market. Volatility is going to pick up prior to an earnings announcement because there's so much uncertainty. And so you have people, whether they're buying protection or they're speculating, there's just that demand, that pent up demand for those particular, stocks that are having those earnings events. And we also know that after that earnings event is over, that the volatility is going to get crushed. I mean, these are things that we know for certain will happen. So then it's a matter of how do we take advantage of that? So we look at the expected move going in, and with volatility higher, that expected move is going to move further out, which means that typically if you have a stock that's trading for 50 and the typical expected move might be $10, well, going in front of the earnings event, it might be $15. So if we know what that expected move is, and we understand that 80% of all earnings announcements fall within that expected move, well, the first thing that we want to do is go outside that expected move by using a strategy known as an iron condor. It's a range-bound strategy. The other thing that I look at, though, is I want to look at past earnings events and how those reactions look after that those earnings have been announced. If we see certain stocks, they might be fairly mundane and have low volatility. They're low beta stocks, but around earnings, they go crazy. So I tend to avoid those types of events. But if we see that those earnings moves historically, and we can go back to, oftentimes I'll go back all the way to 2006, 2005. And if we see that those earnings events historically have fallen within that current expected move, we're going to make that trade. And the great thing about earnings trader is that it doesn't matter what the market's doing at the moment. That has no bearing on how this type of strategy works, because again, we don't really care what the announcement is. We only care that it stays within that expected move so we can take advantage. And we typically, on average, I would say we pull out anywhere, we're aiming for 8 to 15% per trade. These trades are typically one-day trades. We literally get in before the announcement and get out after that announcement, as close to the opening bell as we possibly can. But that's how we kind of take advantage of it.
So Andy, Brad is, I should mention this just as in terms of next week's podcast, Brad is headed for Japan with his family for a week tomorrow. So I'll be doing the podcast solo next week. I think I'll have a guest, but do you, I guess a couple things. I know a lot of the trades you make are on sort of, bigger American brand types. Not always though. Are there any, have there been any more, international type investments that have come across your radar more lately? And have you ever been to Japan?
I have not been to Japan, but my parents lived in Okinawa for several years. So, and
Really?
I have a
Wow.
very good friend that lives in Tokyo. So,
Nice.
um, as for international stocks, as you said, I tend to, and this is one of the reasons in the very beginning when you asked, how I maintain certain, I use very boring stocks and I sell premium against those very boring stocks. I don't really care if they're boring. All I care about is that they make
You
money.
play the hits.
That's
Yeah.
why I'm doing this job. I want to make people money. So I keep things very simple. Um, but I'm not seeing necessarily international. And again, I have EFA and stuff like that in some of my portfolios. I have some international exposure, but there are a lot of opportunities that are popping up right now. I mean, some of these boring stocks like Coca-Cola, like 3M, companies that aren't going anywhere, that are seeing 52-week lows. Some of them are seeing 3-year lows. And when I can have a stock like that and I can say sell a put 5% below that and bring in 2 to 3%. So inevitably I have my cost basis has been lowered by 8%. So I'm getting into a stock that I don't mind owning at 8% lower after it's already seen, after it's already gotten hammered. That's the types of opportunities that I look for, because it gives me a little wiggle room just in case it does go lower. But again, I'm only selling puts on stocks that I am more than willing to own in my portfolios. If it's something that's, I don't sell volatility just for opportunity. And what I mean by that is if there's a small stock out there or even a large cap stock and that, the volatility is kicked up, but I'm not necessarily I don't feel comfortable with that stock and owning that stock, I just, I move away from it. But if it's something that I don't mind owning for the long haul, yeah, I have no problem. And we're seeing quite a few of those opportunities pop up where we can get into stocks that, 5 to 10% below where they're currently trading. And they're already hitting, as I said before, some 52-week lows, some 3-year lows. So again, those are the types of opportunities that I look for, particularly like in my income trader service.
So it's interesting that you brought up Coca-Cola. This is a little bit of a non sequitur. The most common sort of refrain that I've heard about Coke and Pepsi taking a hit is that Ozempic and Wegovy is going to cause people to stop consuming junk food, and that tighter consumer spend is going to impact people are going to trade down in brands and go to house brands or whatever. That seems like nonsense to me. Do you have?
Won't Ozempic and Wegovy help people rationalize consuming those things even more?
No, I think it makes them not want to consume them. But Coke
Okay.
is trading at levels that they just don't feel like snacking, right? Coke is trading at levels that it hasn't been at since before the pandemic.
Yeah.
I mean, it's up 17.5% in the last 5 years. It's trading at August. No, let's see. June of 2019 levels. It's kind of staggering to me, frankly, although it's trading at 21 times earnings. So, maybe some of those lower earnings targets are biting it as well. But the bad narrative fit to a lot of the explanations for why these individual stocks are selling off does give me a little bit of pause. It does seem like maybe the interest rate regime that we're in now is going to hit companies differently than it has over the last 15 years while we've had these basically non-existent lending rates. I was, thoughts. Yeah, it looked like you wanted to say something there, Andy.
Oh, no. My whole thing is I think a lot of us agree with this, particularly those that have been doing this for a long time. When there's bad news or something is being, it's out of favor, that's when the opportunities are truly available to investors. That's when you want to pounce on. When it's really difficult to, when you feel as though it's difficult to buy something and you're thinking of selling something because it's been hammered, those are typically the opportunities that we have to truly buy something and make real money. Going back to Coke, for instance, I can sell puts on Coke and bring in 2% every 30 to 45 days. And if it doesn't hit, whatever is it trading out, 52.5 or somewhere around there. So if I sell puts at the 49 level or the 50 level or a little bit lower than that, again, I can bring in 1.5, 2%. I can do that in perpetuity if I so choose, as long as it doesn't come below that strike at expiration or fall below that strike at expiration, which I would be then issued shares. But I'm lowering my cost basis each and every time I do that. So if I'm doing that over the course of 3 months, well, I've already lowered my cost basis by 6%. On top of, I'm already selling a put that's 5% below where the stock's trading. So now my cost basis is 11% lower than where the current stock is trading. And for instance, in Coke, again, very boring stock. Don't really care about Coke at all. But there's an opportunity there that I see. And again, these are the types of things, particularly in my income trader service, that I look for. But I agree with you, Brad. I think the consumer staples have been hit, and for good reason, right? I mean, interest rates are higher, recession talk continues, people are pulling back, savings accounts are pulling back. I mean, all these things are kind of leading to something occurring. It's just, when is it going to occur and how bad is it going to be? And we'll see. No one knows. But if the opportunity is there, I can't foresee the future. So I'm going to take advantage of that opportunity.
Yeah, and even if you get put Coke, you're currently collecting 3.5% at 52.60, which is what, 4% at your 11% discount. So you're going to start. I mean, you're essentially earning the risk-free rate and dividends on top of everything that you're doing to generate income from selling calls as you go through that cycle.
Right.
Yeah. Well, again, let me go over the returns. So I highly recommend Cabot Options Institute, Andy's services, to anyone, even if you're just, you're relatively new to options trading. It's pretty, I think Andy, you usually refer to it as mechanical. Do sort of the same process over and over, and it works to the tune of, again, 165% return in quant trader since inception. Again, inception June 2022, 97% in income trader, 78% in earnings trader, and a mere 14% in fundamentals. But again, that beats the S&P's return over that time of 4.4%. You can find them all at the cabotwealth.com website under premium advisories page. It's all under Cabot Options Institute. Andy, any last final words of advice, encouragement? Brad, if you wanted to have someone in your have Andy in your bear cave, perma bear cave with you, you should have waited until the market was up a lot, because Andy loves the mean reversion. He's stock or market agnostic. He just likes the mean reversion.
Well, a lot of people, it was funny when you asked me to come on, because I'm like, oh, everybody thinks I'm bearish now.
I knew you weren't. I knew you weren't coming into this just because our discussion the other day. But I also knew that anytime there's an extreme in one direction, you like the odds of it going the other direction.
I was bullish before the rally took off, and the next month I had talked to Mike Santolo, and I was like, yeah, I'm done, talking about this, giving a call as to where the market's headed. And then, but that's the thing, when you're a mean reversion trader, as most know, it's like you kind of look like an idiot for a little while until it does happen, if it does happen. Thankfully, it's, I've been very fortunate. But again, by staying mechanical and this is the most important piece, you have to be disciplined when it comes to risk management. And I don't think that enough people talk about that. We all, you watch CNBC, Bloomberg, listen to, Bloomberg rate, whatever. No one's talking about, risk management. That's boring stuff, right? But it's incredibly important. And
we like to talk about the boring stuff here on Street Check.
You want to talk about boring stuff? Right here. I'm all for the boring stuff. So
the analogy we always make in comparing your options trading style to Jacob's is Jacob comes out and he's trying to hit doubles and home runs, and we always say, oh, you're coming out and hitting singles. I have an alternate pitch for you.
Jacob's a launch angle guy. Andy's a Tony Gwynn or an Ichiro. Yeah. Anyway,
Andy's a pitching machine.
Tony Gwynn comparison.
Andy's a pitching machine. Yeah. He's just He's just firing them consistently down the pipe, and the market's going to do with it what it does, and he's just going to keep working.
Well, and that's the interesting thing is that, I'm often asked, which strategy of the four is the best? It's like, well, it's the one that's working. I mean, there's really no best strategy. They all work, but it has to be a suitable market. And that's why you want to diversify. It's like, a lot of people will ask, well, what's the difference between what Jacob does and what you do? I mean, Jacob and I have been doing this for a long, long time, and we both have different approaches, but we're both very successful in our approaches. I mean, Jacob's had 150% gain recently, 170% gain recently. So it's just a matter of the approach, and then following that approach up with a really strong, disciplined risk management technique that you use. And most of that has to do with just your position size.
Yep. Bulls make money, bears make money, hogs get slaughtered.
Yeah.
It goes hand in hand with your crystal ball in the shop.
Yeah, exactly.
Well, Andy, thanks for joining us, and thanks everyone for joining Street Check. You can always email us if you have any comments, questions. I want to compliment Andy's and my shirt. streetcheck@cabotwealth.com. And as always, give us a like, subscribe, 5-star rating. You can write us a review if you feel so inclined. But yeah, any final words before we sign off? Brad, safe flights to Japan.
Thank you.
Andy, what was that address for your friend in Tokyo? Brad, I'm sure I can find it easily.
Well, no, same thing. Safe travels, Brad. And Chris is going to put the link in for the shirt if you wish to purchase.
Yeah. They could just give me. Well, I'll give either my address or yours. I don't know which.
Made famous by Alec Baldwin in Beetlejuice.
Yes, exactly.
Two middle-aged white guys with the same haircut. I just can't escape it.
Beetlejuice filmed in Vermont, famously,
Exactly.
and part 2 being filmed right now, or will once the actors' strike is over again. Fun fact. Okay. Thanks again, Andy, and we will see you on next week's episode of Street Check.
Sayonara.
Okay.